Hello, everyone. This is the second installment of our discussions about Banking 101. We have started with why banks exist and how they come about. And we basically reached a conclusion that when you have multiple people in the economy who want to put their money in somewhere safe, and at the same time this system, this very safe vault, needs to be built, needs to be maintained, then the only way that you could make it happen is by this vault, this bank, to basically accept the money from others as a loan or deposits, pay for their generosity, i.e. interest on deposits, and then in turn takes this capital that it has and extend loans to other people. Now, safest, simplest term, it could be, a U.S. Treasury a T-bill that earns a little bit of money, and so they can only offer a little bit, less than that to the depositors. So, what we describe is pretty safe. Then why would we have bank runs? Well, if you ask that, it's we basically said that banks are supposed to bring savers and users of capital together. But what we just described, which was a bank that takes your deposits and parks it in T-bill, doesn't do that. I mean, it doesn't grease the wheel of the economy. So aren't we supposed to, grease the wheel of economy? Yes, of course. That's exactly what they're supposed to do. So, to motivate and see how that might work, let's say that Jill needs $1,500 to buy a scooter. Now, again, remember that Jill only has $1,000 herself, so she can't buy the scooter. She got to bring up with the remaining $500 from somewhere else because she doesn't have it. And now, let's assume that we don't have a bank in the economy. So how could this happen? Well, one way that this could happen, if you recall, we have three people in this economy. There's Jill, Jack, and Jerry. Each one has $1,000. Jill wants to buy something that is $1,500. She doesn't have all of it. She needs to come up with the remaining. Well, maybe she could approach Jack and say, look, if you give me $500, I would write this piece of paper that says I owe you $500. And for your trouble, I would offer you a 3% interest, which is, $15 that Jack can earn. Well, if you recall, this is more than what Jack was already earning. Well, we don't have it, but if we had Janice's bank, this is even more than what Jack would have earned by parking all of his money in bank. So, it's a pretty decent proposal. Now, this might happen. The problem is that, of course, Jack can all of a sudden need his money for, something else that he needs to buy. So what's going to happen? Well, Jack is going to go to Jill and said, look, I know I lended you $500, but I need my money back. And so now Jill has to sell the scooter and give Jack his money back. Well, what's the point of buying a scooter if someone who lends you the money can basically walk in and ask for the money back? Well, Jill might think, well, what if I go and, ask Jerry? Well, it's the same exact proposition and it's the same exact problem. Jerry can come and say, wait a minute, I need my money now after, he lended it, I don't know, maybe a month ago, 2 months ago, a year ago, 2 years, who knows? But at some point in time, he can come back and ask for his money back. And here we are, Jill has to liquidate, in other words, sell the scooter, pay Jerry back. And if that's what you expect to happen, that's one of the possibilities. You're always in this fear of, then what's the point of borrowing if at some point in time someone forces me to sell what I need? I mean, after all, she needs the scooter to go to work, shopping, et cetera, et cetera. Well, one possibility is, well, what if we split it? Well, if we split it, you split the difference. You think, all right, so I borrowed, equal amount from each one. And yeah, one of them can come and ask for the money. But if you think about it, sure, it's less money that is needed, but it's still, if Jill doesn't have the $250, she still has to do the same thing. She still has to sell the scooter to pay whoever is asking for it, whether Jack or Jerry. So what you begin to realize is that in this scheme, in this economy, the problem with what we have, which is basically a crowdfunding problem, right, is that when the crowd funds what Jill wants to buy, the crowd has to guarantee that it would never force liquidate what Jill bought. And that's exact opposite of what liquidity means. If it's my money and I can have access to it, then why would I ever make that guarantee? And for that matter, why would, even if you make the guarantee, there is no guarantee that you're going to hold up the end of your bargain, right? You could easily go back and ask for money for all kinds of reasons because you're in a bind. You want your money back. So we're back to what we had before. Everyone wants to park their money somewhere safe. Everyone wants to give money to this bank because the bank not only borrows your money and in turn gives you a return for the pleasure of having your money parked in somewhere safe, but the bank can now come and say, all right, well, we could lend to Jill. We have $3,000 here. I mean, it's not like we don't have enough money. We've got more than enough to pay, give Jill the $1,500 she wants. And instead of Jill paying either of these guys 3%, we're going to get the 3%. That seems to be a fantastic idea. After all, I'm paying $30, on a whole to all these people, and I'm earning 45. So I'm, gaining $15. That's a profit for me. Fantastic. What is more fantastic is that now I have $1,500 of cash in the bank. I gave $1,500 to Jill, sure, but there is $1,500 left in form of cash, which basically now means if every single one of them walked in and said, we want half of our money, that's okay. I'll write a check for $500 and they all can walk away with half of their money and we still are okay. We still are in a situation where I'm earning from my loan and I'm still in positive. All right, this sounds great, right? I mean, there's nothing wrong here. But wait a minute. You said each up to 500. Well, what if they want all of their money back? All right, well, let's explore this. If all of them want their money back, well, let's start with Jerry. Let's say Jerry walks in and say, well, I want all of my money back. Well, I had $1,500 in cash. I can say, all right, you can have your $1,000. Then Jack walks in and Jack says, I want all of my money. And I'll look around and I already had 1,500 cash. Someone took $1,000 of it. I only have 500. So I can't give Jack all of his money back. I can only give him back 500. Now you begin to appreciate the gravity of the situation. Now we're in a position that when Jack walked into the bank, because I've already locked in 1,500 of my money with Jill in form of a loan, and Jill loves that proposition, right? Because the bank is not going to come say, sell your scooter. I want my money back. That's not what Jill expects. That's why Jill loves to borrow from a bank. But now I'm in a bind. If people walk in and take too much out of the bank, at some point in time, we're going to have a problem. We're going to have a run on the bank. Everybody now, the moment Jack walks out and said, they're not giving my money, they only gave me $500, everybody's going to rush to the bank. And of course, at this point, it doesn't matter because we already closed the doors because there is nothing left in the bank to pay anybody. Now, is it because of Jack? No, it has nothing to do with anybody. Jill can come and basically start this fiasco. Jill can come in, and since the second one that walks in, the moment she asks for money and I can't pay all of it back, again, we're going to have a run on the bank. So what we're basically saying is large withdrawals are going to lead to bank runs. Yep, that's exactly what we are saying. You think this is funny? No, it's not funny. It's not funny at all. But it is a function of the banking system. As we have seen, as I have given loan to other people, that these loans became illiquid. In other words, I gave money to someone to buy an asset like a scooter with the promise that we're not going to come and force you to sell it, then we're in a bind. The moment anyone walks into the bank, since we parked our money somewhere for longer term, illiquid, et cetera, we don't have enough cash to support very large withdrawals from the bank. Well, what's government got to do to do it? Well, I mean, to be honest, if we believe in a purely capitalistic system that, government has nothing to do with it, really government has no role. However, that's not true pretty much anywhere in the world. What is happening here in the US and elsewhere, for that matter, is that the government comes and insures these deposits up to a point. Well, wait a minute. What do you mean up to a point? What's the point? Well, here in the US, we have FDIC, which FDIC now says that about $250,000 per bank per account name is insured. So if anything happens to the bank and the bank can't pay, then FDIC is going to step in and basically pay the depositors. And for the pleasure of providing this insurance, FDIC basically gets an insurance premium for all the banks that are a member of its system. But now, wait a minute. What if I have a family that has 2.5 million? That's 10 times of what you just said. Yes, you have a couple of options. You can go in 10 different banks and open accounts for $250,000 each. You could separate all of this and put them in 10 different names, or you could do a combination thereof. So there are ways to be able to basically take advantage of the insurance deposit and yet insure larger amounts. But at the end of the day, the fact remains that when you do have large deposit withdrawals, banks are going to get into trouble, because what they do naturally is that they take these deposits and in turn grease the wheels of the economy. They lend for people to buy scooters, cars, houses, start businesses, etc., etc., etc.